Hello, guys, and welcome to everybody that is attending the webinar. Welcome to our first webinar in 2022, and we wish you happy new year to everybody and all the best for this year. So let's get started now with our webinar. Welcome to the new people that just joined. As I told before, and for those who weren't here yet, my name is Pedro Alcedo. I work with SBI, and I've been a member in SBI since 2018. I'm going to be hosting the webinar tonight because Diego got COVID and he's not feeling very well. Nothing serious, but he's still with some congestion and he didn't want to be. He didn't feel good to do the webinar. Okay, so no more, let's start. Let's start now with our presentation. Okay, so tonight we're gonna be having Jeff here, Jeff Seal with Groundfloor, quick and flexible capital for real estate investors. Tonight's webinar, we started at 6:30, welcome. Now 6:35, we're gonna start actually diving into the content of the webinar. And we're gonna be listening to Jeff's presentation and all the information he got for us about his company and how he can help us on our investment business. And at 7:10, 7:15, we're gonna start with the Q&A. Please drop your questions in the Q&A box so we can read it at the end of the webinar, okay? For the Zoom participants that are here, as I just told you, please drop your questions in the Q&A. We don't have a poll for tonight. If you want to talk something to our moderator, Enid and Oriana, lovely ladies who are always here helping us, please drop her in the chat. And for those who might not be interested in the topic, in tonight's topic, then you can leave the webinar right here. This event is for you guys to help you as much as possible. So please, we encourage you to do all the questions that you have. Every question is a good question, so don't hesitate on put it in the Q&A so we can answer it at the end of the webinar. So now you get to know me a little bit better. For those who doesn't, my name is Pedro Alcedo. I was born in Venezuela, in a state called Mérida. Then I moved to another city called San Cristobal. That's when I grew up. And I went to college in a university called University Católica of Del Táchira. This is the name of the state. I got a degree in business and administration. After I finished college, I moved to Caracas, which is the capital of Venezuela. And I started working in the stock market in Caracas. After the stock market shut down in Venezuela, I moved back to San Cristobal. My family had a cattle raising business, so I got a ranch and got into my family business. For different reasons and the political and economical situation of Venezuela, we had to move out of Venezuela. So we moved to Houston back in 2017 with my wife, who was my girlfriend at the time. And we got married here. In 2018, we started our real estate investment company. And we joined SBI in June that year. I've been working with Diego and SBI. I'm the national sales director, and I'm still a real estate investor. I'm also helping Diego and the investor for the co-housing model and the acquisition side. Pretty much researching for those who are not completely into a business. I can help you guys with the acquisition of the properties and putting the deal together on the co-housing side. SBI. For those who are not related to SBI, StratiVentures was established in May 2012. We are a national full service real estate investing company. The four main components that we have, So, and how we can help you guys with your real estate investment business is acquisition and analysis, real estate services, um, private money services, and funding, and project management services and funding. Okay, if you have any questions about us, if you wanna get to learn more about SBI, please don't hesitate to contact Enid or Oriana in the chat, and we can have a meeting with you so we can go more in depth into what the company does and how we can work together, okay? This is part of the team of SBI. You have me right here, Diego, who is the COVID guy for tonight, and also part of the team, Eric Christie for inspections, Stacy, real estate services, Ron Dancy, who can help us with architecture and engineering, Maria, selection design, and also the rest of the team. You can get to know them in future meetings if you want to. The identity in SBI and what we look in SBI is to mitigate the risk. Every investment situation in real estate or in any other market, there's always risk involved. So our purpose in SBI is to mitigate the risk as much as possible, right? That's why we create a definition that an investor is a person that analyzes, acts, invests, and profits out of risk. Risk is always going to be there. Our purpose is to have a professional team in every step of the process to help you mitigate the risk. Tonight, we're going to be talking about lending. So we're going to be talking more about investment and how they can help us mitigate the risk, and also with the financial side of the deal. Let's have a chat. Visit us for a free one-on-one training session. Tell us which one you want to learn. If you are a beginner and you're looking to get started, if you're looking for rehabbing or new builds, if you're looking for a flip, or you're looking for rehabbing and new builds for rentals, the co-living passive income, which is something that we're doing a lot, started when we started last year. We can also explain you a little bit more how everything works. And Jeff here, they are lenders, co-housing friendly lenders, right? And also private money lenders for those that I always tell those people that they don't want to get their hands dirty, but they have money that they want to put to work. SBI can be a safety net for you guys, so you can invest your money in real estate in a safe way. You can visit our landing page, investorrealestatetraining.com. You're going to have a lot of information there. And also, of course, you can contact our team and so we can schedule a one-on-one session. Okay, so our speaker for tonight from Groundfloor, Jeff Seal. He's the director of organizations and Groundfloor, president of a national hard money lending firm, over 14 years of experience in the finance and default servicing industries, spent 9 years working for several national real estate auction platforms. Jeff is an avid competitor for cycling and running. So you seem like you're in shape, right? and in his spare time, he sits on multiple boards within his community with respect to ministry efforts specific to men's ministry and Hands to Serve. So Jeff, I give the word to you. You can take it from here, and then we'll be answering the questions at the end of the presentation, right?
Awesome. Thank you so much for that. I appreciate that. All right, let's see if I can figure this out. Let's see. Oh, can you pull your screen off there, and then I can throw mine up?
Sure.
Awesome. Thank you again, guys. I appreciate the time you're giving me. Find the right screen here. Perfect. Can everyone see my screen?
Yes, sir. We can see it.
Awesome. Thank you, guys. Well, yeah, thank you for that. Yeah, Jeff Seal, Director of Originations. This is actually my second tour at Groundfloor. I worked here previously a few years ago, had left, created my own brokerage shop, my own origination shop, and everything was off and running, and then COVID hit, and that all kind of blew up. Lost my my funding facility, and had always been in great contact with Groundfloor. They had actually funded a number of deals that I couldn't even during that time frame. So I ended up coming back, and it's been a true blessing to come back. Came back at the right time, and we've seen some massive growth over the last year and a half. So it's been a good time. But today, of course, in lending, everything is very situational, right? It's all about the transaction you're in. Everything is very asset based. So of course, I'll cover what I can on a very, very high level, and then would love to hear what other questions you have, whether they kind of drill down specific to questions or to projects you're working on, or it just further kind of lays out what I'm trying to say. So we'll of course, I'm actually very much looking forward to your questions here at the tail end. But here we go. Nevertheless, so we'll start off. This is where we are. Okay, so we've been around about 9 years, and since then we've expanded into about 35 states. Most of what we do is up and down the Eastern Seaboard and through the Midwest, I would say. But we've recently added states like California, and then I think Oklahoma was a recent add, Kansas was a recent add, Arkansas recent add. So we're, where it makes sense and where we can, grab the appropriate licensing or get comfortable with the foreclosure laws in those states, we'll jump into those states. And if you don't see yours here, let me know. It's not that I won't do them. It's just we haven't had enough business for it to make sense. So if it comes up and you have a state that you want to talk about, by all means, let me know. But this is where we are, right? All right. So to get into it, first I want to cover who we are. We're an investment platform. If you approached our CEO and said, "Hey, I think you have a great origination platform," he might slug you. He really had no interest in creating a lending company. His goal was to create a platform that allowed non-accredited investors to invest in real estate. So anyone with $10 can jump onto the Groundfloor website, find a property that they like, an area that they like, an investor they know, and invest $10 into a real estate transaction and earn an average of 10% on that transaction, right? And that's 9 years proven. That's not just theoretical. That is the average earnings on the Groundfloor platform. But that was the premise. That's why we created it. And so that's why it exists now. Now, of course, in order to have something to invest in, you have to originate loans. And so that's where I come in and my team comes in. So, but yeah, that's a quick brief history. Stairs is a recent app that we created, very similar to Acorn, if you've heard of Acorn. So it's just a high yield savings account, very liquid. If you invest into Groundfloor, into one of the properties, you're of course in it till it's done. Stairs, that money comes in and out very easily, like a savings account, and you earn anywhere from 4 to 6% on that money. That was recently launched just a few months ago. It's actually super exciting. There's updates all the time. Highly recommend you check it out. Both of them feed what we do on the origination side, and both of them yield a pretty good return, all things considered. So that's what we are. Like I said, we are crowdfunded, so it's not institutionally backed. We don't get our money from someone in New York or an insurance company or whatever that's just looking to put forth a lot of money into real estate, and they want to control the credit box and what it looks like. We get to control the credit box. That's the beautiful part about working with the crowd. And what's nice is the money that we are lending is the money that myself and people like me put into it. And there's something kind of beautiful about that. It's just not someone sitting in an ivory tower somewhere trying to invest money. It's just a bunch of, I guess, little people that are throwing money in as little as $10 up to a few million that invest in our platform. I like that. I like that part about Groundfloor. And like I said, we do get to control the credit box, which is nice. We have an appreciation for StratiVentures in that model. It fits our culture and values. It's very, it's not about telling you how to do things. It's showing you, coming alongside you and doing them with you. Right. I like that. Our BDMs, one of the things we try to focus on is education. It's not about just throwing out quotes. It's throwing out those quotes and telling you why that quote exists the way it does. It's throwing out quotes and telling you why that property doesn't work based on what you're paying for or the rehab that you're expecting to do it, right? That's the fun part of the job is the educational aspect of that. And so I feel like we align well with what SVI is doing. So I like that, and you should expect that. I think lenders should be a checkpoint if you have a good one, right? If you have to go to 3 lenders to find a deal to work, maybe you should find a new deal, right? The goal is if it fits with a lender, then it's a good deal. It should be a checkpoint. You should have a lender that's willing to have those conversations with you. And we actually very much appreciate that part of the business. And we are asset-based lending, right? So just to further separate the difference between what we do and what a bank would do, of course, is it's not about it's not about you. It's not about your financial position or your financial strength. It's about the asset. Does the deal make sense? If you buy it right, you put in the right amount of work into it, is it going to be worth the right amount, right? So a lot of the decisions that we make, aside from your experience, is driven specifically by that project. And so if you could be on your 10th deal coming back to us, and all of a sudden something might change, and that's because you're doing a deal that's a little bit different and it deviated from what you did before. So, so that's who we are. So this is what we offer. All right. So we do short-term interest-only loans, 6 to 8 months in duration, right? We're in the purchase and rehab business. That's what we do. We have a strategic partner that handles our term products for us. That's a recent setup. So if you have those types of needs, we can assist in that. But it is not funded by the crowd. It is not something that we currently offer from our own capital, but it's something, of course, that we can help with. But most of what we do is going to be your purchase and rehab type scenarios. And within that of course includes your refinances. So if you're in the middle of a renovation, ran out of time, you need to refinance and continue your rehab, we can support that. If you're bridging it, if you're done, you're ready to sell it, but you need to buy some time, we can do that. And if you're just ready to cash it out, we certainly can help there. But again, it's all short-term interest-only type loans. Okay. New construction, big part of our business, actually. We do new construction in a really big way. So it's a product that we very much like to do. So if you have those types of scenarios, we are more than happy to assist in those. One of the things that makes Groundfloor unique is definitely our deferred interest payments. We're one of the few companies in the country to do this, and it's not done by increasing a rehab budget or doing anything anything with the actual loan itself. It's truly a deferred interest. There are no monthly payments for the life of the loan. Okay. So you talk about if cash is king, our ability to ensure that you're not stroking a check every 30 days, only to make it another 30 days to stroke another check is truly powerful. Excuse me. So that's big. So the interest just accrues on the backside, and excuse me. And it's at disposition, whether it's a refinance or a sale. That's when you pay the interest. Okay. Interest rates range. It's 6.5 to 12. It's really based on loan to after repaired value. That's the real driver behind it, right? And then experience is secondary to that. And so you might be a phenomenal investor, 10 deals under your belt in the last 5 years. But if you are maxing your loan out based on after repaired value, you might pay a 10% rate, right? But if you put money into that transaction, you can drive that rate down. So if loan to after repaired value is the driver, the more cash you inject into that transaction, the lower your rate can be, right? So it's kind of one or the other. If you're interested in rate, we can accommodate that. If you're interested in maximum leverage, which I highly recommend, we can certainly accommodate that too. So deferred payments, okay? The second thing that makes us a little bit unique on your origination points, we roll those and finance them right into the loan. Okay, so when we're quoting you, it does get a little confusing because when we're quoting you loans, we are covering, let's say if you're a 90% borrower, we're covering 90% of your purchase, we're going to cover 90% of your rehab, then we're going to cover 90% of your origination points. Okay, those are all financed into the loan, so you bring 10% of that. Okay, it gets confusing when we're quoting you out. That's just because it's grossing up, accounting for your origination points. So it is a little bit confusing, but it's a huge benefit. Again, trying to make sure we can do what we can to keep what cash we can in your pocket, so that when things do come up, budgets do change, struggles come up, you have the funds to cover that, right? So there we go. No bank statements needed. So everything we do is very asset-based, right? And since we don't collect payments, there's really no need for us to collect bank statements to prove that you have the cash to service the debt. So there's no reason to gather a bank statement. The only time we do that is if you're doing a new construction deal, we do look at one bank statement to confirm that you have a certain percentage of the budget, but that's it. That's the only time we ever qualify cash in the account to do anything for any of our loans. So not bad. No tax returns or personal financial statements. So nothing to worry about there. Again, your financial position is assumed good. Otherwise you wouldn't be looking to do a fix and flip transaction or new construction or any type of investment transaction. So that is assumed. We're not looking to document that. Another benefit we have is we recognize, and this is something we changed recently, is we recognized where everything kind of goes wrong in the transaction, right? It's usually the borrower never has bad intentions or the lender never has bad intentions. It's the budget changes. We try to make it finite. We try to make it biblical when we close, but it's not. Things change. And so with that, it becomes struggles, right? Especially if you're way off to begin with. And so what we do now on the front end that we find more valuable than appraisals is a feasibility inspection. Okay. They're not looking to, it's not like an FHA inspection or anything. They're not looking to disqualify the home. They're making sure that your budget does have everything that it should. So if you have a blank HVAC line item for $0 and the inspector goes out and recognizes there's actually no air conditioning sitting on the property, he'll let us know where those shortcomings are. And so we can relay that back to the borrower and say, hey, did you know you missed this? Or did you know the pricing on this could be a little low? And so we get that data, we share it with you, we let you know, because we want to make sure the budget is as strong as it possibly can be. That guarantees you're going to be successful. Okay. So feasibility inspections are closing your 2 to 3 weeks, not crazy fast, not super slow. These are slowly getting faster. About every quarter over 2021, we got about a day faster. And so we're running around 18 days over the last 9 years. That's about the best quote I can give you as far as timeframes. We certainly close some quite a bit quicker. And you know what? You're only as good as your worst vendor. Sometimes you close them a whole lot slower, right? So that's just kind of the expectation. So, and then like I said earlier, we're not getting appraisals anymore. We got rid of that. We went to a BPO, we got rid of that. The value of those continues just to kind of go down. It's much easier for us to determine value internally. If feasibility inspection says that everything is feasible, it's pretty easy with a number of tools that are available these days to determine what the as is and after repaired values are going to be. And so we just nix the appraisals, which of course is going to start saving us even more time. And so that's what we offer. That's the high level. All right. Believe it or not, this is pretty much my last slide. Like I said, we're going to go pretty high level. So this is the leverage that you can expect. Okay. As you can see, we work with brand new borrowers that just have no experience whatsoever, that are coming to SVI maybe the first time to get some guidance. We can help you with that, right? We'll still offer 80% of your purchase and 80% of your rehab, up to 70% of an after repaired value if you're brand new to the space. Okay. And then as you can see, it goes up from there. 2 to 3 completed projects moves you up to 85. 4 completed projects will get you to 90, and that's 90% of purchase and 90% of rehab. And then if you've done, and all this is based on 5 years, by the way. So if you've done 8 deals in the last 5 years, we'll actually cover 100% of your purchase and 100% of your rehab. Now, to reference a couple of slides ago, keep in mind, I'm also rolling in points. So if you're a high level investor, if you're in this tier 5, so to speak, that loan leverage day one is 103%, right? It's going to roll in points. And it's going to cover 100% of your purchase, and we're going to fund 100% of rehab, up to 75% of every. So it's a very, very strong product. To clarify a little deeper, so the way we typically do loans is not based on a fully funded budget, right? So there's just so we're clear on the apples to oranges comparison to other hard money lenders. A lot of them quote 80% of purchase, 100% of rehab, 90% of purchase, 100% of rehab. Right? Ours doesn't size out that way. Ours is 80, 85, 85, 90, 90. So it's purchase 90%, rehab 90%, and then you bring the 10%. And the reason we do that is we don't have any limitations on the size of budget you can have, right? So a lot of the companies out there, they advertise those, but of course you have to be cautious. The budget can only be so big as it compares to the purchase price. We don't have that limitation with our standard product, which is where we'll fund between 80% and 90% of purchase and 80% and 90% of rehab. Hope that makes sense. Where it does matter is in that loan 100 product, it does matter. We have limitations on the size there. And then as this little footnote I put in here, we do have a 9100 product. So we do have that available. And the reason we created that is to ensure that we are competitive and we can get an apples to apples comparison to some of the other lenders out there, because a lot of times it gets confusing. And so we do offer this 9100. And if you have 4 or more flips in the last 5 years, well, you can do a 9100. And the only caveat to it is your budget can't be more than the purchase price, right? So if you have $100,000 purchase, you can't go over $100,000 rehab. So there's a 1-to-1 ratio you can't breach, which is pretty much what the rest of the industry does for the most part. But we do have that product, and it kind of falls in between the 90/90 and the 100 product there. So that's the leverage. That's kind of what you should expect. Again, crazy high level. There's a lot of if this, then this through our underwriting guidelines, but hopefully that kind of gives you, the gist of what we do. So that's kind of all I have from a slide perspective. If you have any further questions, here's my email address. You're welcome to email me directly. If you have a deal, if you have a project ready to go, I can put you in front of one of my BDMs. We can certainly take a look at that immediately, or send it over to Pedro, of course, and he can send it to my team, however you'd like to do that. But that's the presentation. And I'd love to hear and see any questions you guys might have from that. Let's see here. Pedro, what do you recommend? Do I just go right into the Q&A and give it a go?
Yeah, no, actually, I had a few comments that from what you said that I thought it was going to be important for me to remark, especially for those who are new. You said something about people, going from lender to lender, kind of chopping around because one lender rejected the deal. Guys, if you're working with a good lender, they are going to be a second set of eyes for your deal. So if you're getting rejected from one of them, that means that your deal might not be a deal. So get out of trouble, keep yourself out of trouble, and just go with your lender. And that's one of the first clues and first keys that we look for in lenders when we're going to start working with them. Because a good lender will like us to succeed in all deals so they can get their money back. A bad lender, they want us to fail so they can get the deal for them. So that was really great on everything that you just said. So yeah, we can jump in with the questions now. I don't know if you have access to the Q&A or you want me to read the questions for you.
I think I do.
We can start answering one by one.
Yeah, I think I do. Starting with Lynn here. Is that what you're seeing?
Yeah, that's correct.
Great.
Lynn Michael Perez. Hello, Lynn.
Hello. So does Groundfloor grade crowdfunding investment opportunities? Yes. So we do. That's a great question. I'm glad we got back into the investor side. So if you go to the Groundfloor website, you can you can do it. There's actually a system in there called Merlin, so it'll just kind of auto invest for you. But if you're interested in something that's uber conservative, you can move into loans that are graded at an A or B and go into that tranche and maybe earn around 8%, right? And if you want to go right down the middle, you can hit that middle tranche, earn 10% on average. And if you want to go a little bit more risky, and as we probably all know, I mean, we're not going to write loans that are risky, but there are some that are risky based on experience or high leverage, and you have the opportunity to earn a little bit more. And so those will grade from A, B, C, D is kind of what you'll see. But we do separate, we do break those out because there's a certain, because we went through the appropriate steps with the SEC to get the appropriate license, and so we could lend to non-accredited investors. And through that, they're going to expect certain information to be available to you. And through that, we end up grading it so that you can appropriately and very easily make decisions on what you want to invest in. So yeah, I haven't been on Prosper, but I assume that's going to be similar. Oh, look, I had one earlier. Looks like there's one from Krista. So can you repeat the origination 3 parts again? So you know what, and forgive me, I didn't touch on the origination costs. I just touched on the benefit of it rolling into the loan. So forgive me. But to go back what I said, the origination points, there's an extra fee, but the origination points are financed into the loan. So they roll in, okay? Those are anywhere from 2.5 to 4 points, all right? And the drivers behind that most of the time have to do with experience. And we're always going to be on the higher side of origination. I'm glad you brought this up. I completely forgot. We're always going to be on the higher side of that. And that's because we're a crowdfunding company that doesn't keep any of its interest. So if I fund a 10% deal and you go out there and you find it and you see this listed at 10%, that's because that's what I funded it at, right? So there is no yield spread that we're earning off of that. And it's something we kind of like to hang our hat on. Downside to that is we got to keep the lights on. So our points are going to be on the higher side, but we try to offset that like extra costs by allowing them to be financed in. So great question. I hope that answers it. Around feasibility inspections, Lynn asks, does Groundfloor conduct feasibility inspections? Are they conducted at intervals? So we have just like you have a national appraisal company, we have a company that we can tap into that takes a local inspector, goes out, snaps some photographs, writes down what he sees. And then we have a feasibility inspection company that will sit down and make sure that the numbers make sense, that that $1,000 for drywall makes sense if you're building out a basement, right? So they'll take all those things into consideration. The feasibility inspection is done once. It's done at the beginning, okay, just to determine the budget's feasible. There is an inspection for your draws. So just like any other hard main lender, it's based on completions, right? So when you're ready for a draw, if you're halfway through your drywall and you need to pay out, great, request a draw. Inspector goes out and verifies that, and we'll wire the funds directly to you. It's a 3 to 5 day process. Our process with that is very, very standard. Hopefully that answers. Insurance requirements. I can send those to you, Mr. and Mrs. Anonymous Attendee. The insurance requirements are, again, pretty standard. I think it's a minimum $500,000 in liability coverage. If I say anything beyond that, I'm going to butcher it. You got to cover at least the loan amount. And it is paid at closing. A full 12-month policy is paid at closing. And maybe that's kind of the point of your question. So you do have to cover that because we don't create escrow accounts for insurance and taxes. They just have to be current. Okay. All right. Next question from Gabe here. How are your interest calculated for new construction draws? So great question. Let me first answer another question that reminds me. So interest is annualized, right? So it is simple interest. There's no amortization schedule. So if you're at 12% interest, your effective interest rate is 1% a month. And so if you're at a 12% interest rate and you're out in 6 months, that's a 6% rate that you are effectively charged for that loan, right? So I want to make sure this group kind of understands that. I'm not going to come after you for the full 12. The time you get out of it makes a difference. Regarding new construction, so we do have an interest on only dispersed funds option if your experience is high enough, right? So we can certainly talk about that. I believe if you hit the second tier, which is 6 or more deals, you can do interest on dispersed, where again, it's interest charged only on dispersed funds. But we do have that for the higher tier borrowers. Absolutely. Okay. Carrie, okay. 2 questions. See, can the Where We Lend map be put back up? Absolutely. Do you mind if I do that real quick?
Yeah, I'll stop sharing my screen so you can share yours again.
And this is on the website. I think if you go directly to the borrower website, it pops up pretty quickly. What did I do here? Go back. What did I do wrong? Here we go. Share screen. Okay.
And just for you to know, this webinar is going to be uploaded tomorrow in our YouTube channel, so you can find the whole webinar again and you can get all this information back, and you can review it as many times as you need, Carrie, okay?
Great, thank you for that. Okay, hopefully that is helpful. Let me see here if I can figure out how to look at the questions now that I've done that.
Yeah, the second part of the question was, is there a minimum loan amount required?
Wonderful question. Minimum loan amount is $75,000. The minimum property value is $50,000. So you could be purchasing it for 45, as long as the as-is value that we see comes in at 50, you can purchase it that for 45. And then inclusive with your budget, once we take into consideration, we're funding 80 to 90%. As long as it's over 75,000, we are good to go. Yeah.
All right. We have Ralph Dyson here asking, does rehabbing rentals, except for co-housing units, count towards those tiers?
Yeah. Yeah. As far as experience goes, absolutely. Rental products count, or rental properties do count. Joint ventures do not, right? So we're going to ask you to fill out a spreadsheet that just says, hey, what property did you close? You're going to put down the name you closed under or the LLC you closed under, and we're going to verify all that. If there's no way to do that, it doesn't count. Like, that's the best way I can put it for you. But rentals, absolutely, they do. Yeah. I mean, yeah, if you happen to be sitting on a pool of 10 rentals, you are qualifying for our 100% program.
All right. Franco Montano asks, is it possible to get a pre-approval? Many agents and wholesalers require a pre-approval before I can get it under contract.
Absolutely. All day long like candy. Yep. We recognize that's a necessary evil in the space. I will gladly issue pre-approvals for you to get contract. Mm-hmm.
All right. Sujan Yoshi asks, on asset-based lending, do you only do short-term loans or do you do long-term loans like 10, 15 years?
Right now, what we do at Groundfloor is short-term. Now, to clarify, we do pull credit like anybody else, right? So it's just the decision to lend has little to do with credit. You could have as low as 600, even lower if you have a partner, and we can overcome that. But as far as the loan itself, if that's what you're asking, everything that we do is going to be a 6 to 18 month type of loan. If you need something longer, we can facilitate that. We have a strategic partner. We have a gentleman at Groundfloor that works and does nothing but term products. I can't speak to that in any great strength, but I can certainly help get you a quote just so you can see what's out there. Absolutely.
All right. And then another part of the question is, do you finance small multifamily units, 8 to 20 units?
Not right now. I actually anticipate that's something we start doing at the end of the first quarter of this year.
All right.
Great question.
Ron Dancy asks, how are the interest rates determined?
They are determined by loan to after repaired value, right? So if you are, and a little bit of your experience, there's kind of a 7-point algorithm that our system does, right? It is what it is. It exists the way it is. It's approved by the SEC and it spits it out for us. Most of our loans fall in that 8 to 10% realm. That's just where most of them are. And that's just because if you're getting your maximum leverage, in order to give you 90% or 100%, we're maxed out at 70 or 75%, then you're just going to end up with a higher rate, right? If you have your own cash you want to put in that to put to work, then yeah, it lowers down to 6.5% pretty quick once you get under like a 60% loan to ARV.
Right.
Yeah.
We have Anonymous here asking, is there a particular sweet spot of ARVs that are too low or too high to fund?
A sweet spot on the ARVs?
Yeah, that are either too low or too high to be funded.
So yeah, well, if you want to talk about the actual percentage, is the actual after repaired values. I mean, yeah, if it goes over 70%, actually, maybe this is the point of the question. We do look at the profitability of the deal, right? So when it goes through underwriting, even if you, the borrower, recognizes that you have to put a whole bunch of money in to get the deal done, if that still looks like a loss leader and it looks like you're going to lose 30 grand, we're going to let you know about it. May not want to participate in that deal because it doesn't look like anyone's going to win. The only time that does, and maybe most of you guys recognize this, is if it's a rental property and you're trying to leave the equity and liquidity you're putting into the deal in there, then it makes sense, right? Because everything that we do is underneath this, like, it's got rosy glasses on the 12-month product, right? The goal is to create equity. And sometimes that's not the goal. The goal is to create passive income or create a rental income stream, right? So if that is the goal, sometimes the profitability does look out of whack. And we recognize that. So your end goal does matter. But we're only going to go up to 70 or 75% of an after repaired value. That's our cap from a percentage standpoint. So I don't know if that answers the question or not. But
I think the question was more towards, like, do you have a maximum amount of ARV? Like, for example, do you lend money on $1 million deals, or do you lend money on $50,000 deals? Maybe Anonymous will need to clarify better that question, but I think that was the point of the questions. Like, if you have a limit on how high or how low can you go on the deal? On the
$1 million. Yeah. So $1 million is our loan amount limit right now. Okay. I'm working actually next Wednesday. I'm hoping to actually increase that a little bit. But right now it's at $1 million.
All right. Great. Yeah. And on the low end, do you have
75? Yeah, 75.
75, which is the minimum lending amount that you have. All right. Howard Moore asks, what if the project is in your homestead that you want to rehab and sell, same parameters as buy and flip?
Read that to me one more time.
What if this project is your homestead that you want to rehab and sell, same parameters as buy and flip?
Got it. Got it. Oh, okay. I thought you were saying, I thought you were saying home state, but it's homestead.
Homestead, yeah.
Got it. Got it. Oh, here, I'm able to see the questions now. Can I do that? So everything we do has to be a non-owner occupied property. Yeah. And to that point, there has to be an LLC involved. It doesn't have to be seasoned. It can be brand new, and that's just falls into like the licensing requirements and things like that we need from a mortgage perspective. But yeah.
All right. La Wanda Davis asks, is it possible to invest with your inside an IRA? Is it possible to invest with you inside an IRA?
I would love to talk with you about that.
Right.
The answer is probably, it depends. I'd be happy to talk with you about that.
All right, so yeah, I'm going to be sharing again here my screen where we have all your contact information. You can also contact us and get the questions, and we'll get it to Jeff, and so you can get your answer.
Yeah.
Yamesi Gutierrez, are your loans reflected on credit agencies?
Great question. They are not. They are not, because the loans are they're being issued to LLCs. So you will personally guarantee the loan. However, it does not show up on a report.
All right. Ramon asks, did you say you have as well how to convert the HML to a conventional loan? I'm planning the BRRR strategy this year.
So great question. Two things I want to say there. If you are looking to do the BRRRR method, I certainly have a rental product that I can lead you into after you finish your purchase and renovation. Second thing I want to mention is I'm in the middle of trying to create a convertible product with another partner that takes you from cradle to grave within that program. So, and again, this is me sharing way more than anyone else knows that Groundfloor is working on. But my goal in the next couple of months is we create a product that allows you to purchase it, and at that time of the purchase, we're actually going to establish a value that is acceptable by the takeout lender, right? And so there's going to be one closing. There's going to be purchase. You're going to rehab it. We've already determined what the value is, and if you're able to do all that within like a 6-month period, we don't anticipate the value changing much, so that we will immediately just drop off the first loan, and then there'll already be the long-term loan that's in existence, and it just takes over from there. So we're working on a structure that hopefully in the next couple of months will accommodate this really well. So we'll see how it goes. There's a lot to that, because there's really two sources of funds that are taking care of it. But either way, in this very moment, if I help you with the purchase and renovation, I can definitely lead you into a Groundfloor approved strategic partner that can take out the loan.
All right, great. Lynn Michael Perez is asking, are Groundfloor crowdfund investors approved for specific states? Investors can't participate with Prosper in Texas.
I don't believe there's any state, and maybe Prosper only allows accredited investors, not non-accredited, or maybe that's the difference. I don't think there's any limitations on the ability to invest in properties anywhere, to my knowledge. I know that I've never seen anything when I've invested on the platform. I've never seen anything that stopped me based on states. I'll have to look into that. Feel free to contact me afterwards. If I can't answer this question, someone on the investment platform absolutely can. If you want to shoot me an email, I can definitely get that answered for you. I'd love to know the answer myself now that you bring that up.
All right. Gabe is asking, will having SBI manage the project allow us to move up in the borrowing tiers to borrow more or have lower interest?
I don't think so. I've thought about this. I don't, it depends. I'm not, I don't know what SVI's involvement really wants to be in the transaction. Pedro and I can talk about that offline. I would love for this to turn into something where I could offer higher leverage based on it being an SVI lead. It is something I would love to do. Nothing exists right now because we're still at the onset of our relationship together. But I would love to see something like that happen.
Yeah, this will be more than being a lead, more like, for example, there are a few investors that are working with us and we are managing the whole project. So the question is going more like having the SBI expertise will help them, since we're running the project, we're managing everything in the project from dirt to keys on the new construction or the full rehab. Will let them have a better tier on the lending side.
I'm open to that. It wouldn't take much of a conversation on my side to figure out if I can do that or not. I'd like to think that I could probably come up with something. It's something that I thought about. And it's, as the relationship kind of grows here, I'm sure that we could figure that out. Right now it's not in writing, I guess is the best way to put it. Okay. I would love to come up with something like that. I'm glad you brought that up. I'd love to talk with Pedro and Diego about that. Sure.
Great. Anonymous, if you happen to foreclose on a property, will my credit be affected?
Yes, because you have a personal guarantee on that. So I believe a foreclosure will end up tracing its way back to you if we do. That is never the goal. We spend a lot of time, energy, and money on the actual workout of that before we ever get to the foreclosure piece. That's not fun for anyone, and it's not cheap. So the goal is to stay out of that. But because there's a PG on the loan, it can affect your credit.
That's right. Uplift management, do you have cash out refinancing too?
We sure do. We'll do cash out refinances up to 70% of the property value. And this is assuming the property is 90% complete, right? It's a livable structure, but we'll do up to 70% on a cash out. And if it's a refinance with no cash out, aside from maybe some closing costs, it'll go to 75.
All right. Art is asking here, what if we have 10 rentals but never done a new construction? How is that looked at?
Looked at very well, right? Real estate transactions are real estate transactions. So you would reap the benefits of the rental properties, right? Very seldom. I mean, if the deal looks completely out of whack, crazy sideways, something's weird, sometimes we refer back to the experience to say, well, maybe they know the area, maybe they've done these types of transactions before, maybe there's something we've missed. You wouldn't gain any benefit there because we're going to go back and go, okay, well, they haven't done new construction, so that doesn't really help. But if it's a line drive, pretty basic new construction, all the numbers make sense. Yeah, you're gonna get new construction. You're gonna get 90% of purchase and 90% of rehab on a new construction deal, or 90% of build. We don't do loan 100 for new construction, to be clear. That's stuck at the 90-90. But yeah, we will absolutely do that.
All right. Gabe is asking, do you loan to single member LLC or only personal loan?
We loan, actually, it's the opposite. We loan only to LLCs. We do not loan to personal people at all. Well, to personal, you know what I mean, but yeah.
Yeah. Only LLCs, guys, only, so you have to set up your structure before getting a loan.
Yeah, absolutely.
Ralph Dyson is saying, let me clarify, you pull credit, and if so, do you pull it on each and every deal that is submitted?
We do pull credit. Again, we're asset-based lender. That has nothing to do with whether or not, that has nothing to do with credit. That has to do with your financial position, right? So asset-based lending means we don't care about your financial position. Credit is something totally different. We do look at that. Want to make sure that you do pay your bills, and that you are credit worthy. So we do pull it. We do not pull it on every single deal. A credit report usually hangs out with us for 6 months. I'm trying to get that extended, but yeah, we don't pull it every time. We pull it once every 6 months.
All right. Gabe is asking, can I invest with Groundfloor with a retirement fund or trust?
Absolutely. Yeah, absolutely. If you shoot me an email, I'll put you in contact with the right people that can explain that in great detail. Anything I say will be butchered, but yeah, you can.
Great. Lynn is asking, they allow non-accredited, or maybe she's commenting about her last questions. They allow non-accredited investor. Texas has not approved Prosper loans in Texas. I will reach out to you, yes.
Yeah, right. That'd be great. I'd love to hear about that.
Anonymous is asking here, do you accept joint ventures partnership with a private money lender who will provide the 10% requirements? Basically, myself and my PML joining to do a project under an entity. Thank you for your answers, time and information, and company services are amazing.
So we can get into semantical babble here a little bit, but yes, I think so. Think about it. We don't gather bank statements, so I'm not qualifying or confirming that you have any type of money in any specific account. So Groundfloor makes it pretty easy to work with private lenders or private people that are getting funds from somewhere else. I hate to say private lenders because what I don't allow is a subordinated lien, right? We can't have a second lien position. So we can't come to closing with two lenders and they expect us to be okay with having that lien there. But you use the term joint venture. And if that joint venture is written up where there's shared equity or they're charging or whatever it is, if it's through a joint venture agreement, typically there's not a lien being placed because there's an agreement in place in lieu of that. If that's the case, absolutely all day long, we will do that. That I don't have a problem with that. It's only an issue when a lien is trying to be filed at closing. And we couldn't do that.
Ralph Dyson is asking, the credit pools, are they hard or soft?
They are hard pools right now. Yeah, they are hard pools, unfortunately. I mean, there are so many things you talk about there, but right now they are hard pools. Mm-hmm.
All right. Eric Rodriguez is asking, what do you need for a pre-approval? Property address or need bank statements?
A 3-minute conversation and a name of the LLC you're going to close under, the property address. Yeah, that's easy. Tell me what the amount. No bank statement needed. I mean, I hope that if you're putting an offer on a property, you got your money. You know, there's a little bit of trust going on there.
All right. And Jessica Morgan is asking, I sent my questions in chat by mistake. I don't know if the ladies here put in the Q&A box or here it is. Hi, Jeff and Strati team. If a person has no personal experience, but you have experience in construction, could that benefit the person with y'all in any way in respect to getting approved to your first renovation?
So at 80%, you don't need any approval. So I'll say that first. So if you can come with me with absolutely no experience, I'm going to find 80% of purchase, 80% of rehab. Now, if you are a general contractor, I'll immediately right now, and I actually think this is going to change in the next couple of weeks. So stay tuned, right? But right now, if you're a general contractor, I'm going to immediately give you the credit for 2, which takes you to the next tier at 85%. If you're a licensed general contractor, if you're a real estate agent or you've done work as a, if you've done work for a general contractor, those things I can't count because they're just impossible to kind of verify. And then real estate agents, I mean, that's great. There's experience there. I don't want to disqualify that, but we if you're a real estate agent, you've sold 100 properties, that doesn't really cover all the bases from the aspect of a purchase and rehab. And unfortunately, we can't count that. But general contractor will give 2. I actually think in the next couple of weeks, builders, developers, and general contractors, we're going to do something special and better that. So stay with me on that one.
All right, great. Well, I think we covered all the questions. Thank you guys very much for all the questions. They were pretty good and very informative. So if you don't have any other questions, guys and Jeff, if you don't have any more information to share, we are getting close to 7:30. So that's the end of the webinar. We want to thank all SBI partners and affiliates that help us with our everyday business and make these webinars possible. So remember, guys, if you want to know more about SBI, if you want to know more about Groundfloor and all their products, just give us a call or shoot us an email, visit our website, and you can scan our QR code right here so you can get access to all our social media platforms. Remember, this webinar is going to be uploaded in YouTube so you can watch it again if you need to review on the information. And we will be happy to answer any other questions that you have or schedule any one-on-one chats to go more in the personal level or see more specifics of your needs so we can answer better.
Thank you
So
guys so much.
I think I have a few more comments here. Well, thank you. And thank you guys. Thank you, Enid. Thank you, Oriana, for your help. That will be the end of the webinar for tonight. Thank you all for coming. And I wish you a very nice week. And thank you, Jeff, for all the information and your help.
Yeah, thank you, Pedro. Thank you, Oriana. I appreciate it. Thank you, guys.
All right. Take care, guys.